Welcome to Books in Sum, your go-to for bite-sized book summaries.
The Intelligent Investor by Benjamin Graham and comments by Jason Zweig. If you want to invest in the stock market without gambling away your life savings, The Intelligent Investor by Benjamin Graham and Jason Zweig is the book for you. Many successful investors, including Warren Buffett, have followed Graham's more cautious, long-term strategy. Intelligent investors don't act hastily, but instead carefully consider the company's potential returns. Investing can yield substantial gains, but it also carries the risk of substantial losses. Contrary to the short-term gains possible through market fluctuations, intelligent investors use thorough analyses to secure safe and steady returns. Instead of focusing on the short-term gains made possible by market fluctuations, they put their attention on pricing in order to ensure safe and steady returns. Informed buyers of stock wait for the price to fall below what they believe the stock is actually worth, taking into account the company's potential for future growth. Before buying stock in any company, savvy investors consider the company's long-term growth and business principles. They spread their bets around so they don't lose everything if the market crashes. At last, they have realized that they cannot expect huge profits, only reliable income. The three pillars of shrewd investing are a focus on the long-term growth and business principles of the companies in which one is considering investing, diversification, and an acceptance that outsized returns are unlikely. For the savvy investor, the goal is to generate returns sufficient to meet her own needs, not to compete with Wall Street's elite. The importance of studying stock market history, as well as the market's own history, is not lost on astute investors. The stock price, earnings, and dividends of the company over the past 10 years, as well as the rate of inflation, must all be taken into account. Investors should also have the mental fortitude to weather a storm, as the market eventually recovers from even the worst crashes. The stock price's relationship to the company's earnings and dividends over the past 10 years, as well as the inflation rate, are two key metrics that investors should consider. It can be helpful to think of the entire stock market as a single person, whom we'll call Mr. Market, in order to better grasp the market's capriciousness. Most importantly, the text emphasizes that the intelligent investor must be a realist and ignore the whims of Mr. Market, who is erratic, moody, and not very clever. Furthermore, when Mr. Market is upbeat, he tricks us into thinking there will be profits in the future where there are none. The defensive investor should select a strategy that fits them personally and create a portfolio that is well-balanced, safe, and easy to manage. Because she fears loss, the defensive investor prioritizes security, which can be attained only through diversification. Investors should allocate half their portfolio to high-quality bonds and the other half to common stocks, as is recommended in this text. To further spread the risk, investors should put their money into large, established businesses that have a track record of success and try to put money into at least 10 different businesses. Last but not least, investors should use the services of a professional to help them. Finally, investors should employ a method known as formula investing, in which they invest a fixed amount of money at regular intervals in accordance with a predetermined formula. Last but not least, financiers should automate their financial operations. The keys to becoming a prosperous entrepreneur investor are the focus of this text. The first step toward becoming a successful, risk-taking investor is to set aside a specific sum of money and use it to purchase as many stocks as possible. Investors should check in on their portfolios every 6 months and consult a financial advisor once a year to make any necessary adjustments to their allocation of common stocks and bonds. Investors who are willing to take on more risk should also try their hand at other types of stocks. For instance, investing in a promising new company can pay off handsomely, but only if you don't have to spend too much. Those who are willing to take risks with their money should only put up 10% of their total portfolio. This is due to the fact that even the most astute investors make mistakes, and Mr. Market can be unpredictable at times. Entrepreneurial investors avoid riding the market's waves of success and failure as a means of safeguarding their wealth. Entrepreneurial investors avoid this by purchasing assets at market lows and selling at market highs. Be sure to keep a close eye on their investments and the portfolio as a whole. Consider whether the leadership is still effective. How is the money situation right now? If you notice that the stock price of a company in your portfolio is rising rapidly out of all proportion to its actual value, you should consider selling before the price falls dramatically. An astute investor may find some incredible deals. At this point, you should be finding the prospect of becoming an enterprising investor to be an exciting challenge. In order to develop your skills as a savvy investor, it is recommended that you invest virtually for a period of 1 year. You can practice investing for a year on one of the many websites that cater to this niche market. Once you've had your fill of virtual reality for the year, it's time to hit the sales. The market tends to undervalue the stocks of companies that are either temporarily unpopular or experiencing economic losses, making these stocks the best place to find a bargain. As an example, let's pretend that Business B is the second biggest player in the refrigerator market and has posted respectable if unremarkable financial results over the past 7 years. Since the company's profitability has dropped over the past 2 months, nervous investors have dumped their shares. An astute buyer would recognize the opportunity presented by the current low prices. However, finding deals is challenging, so it's best to put in a year of practice before diving in. If you follow the advice given here, you should be able to turn your investments into steady, if modest, profits. Wealth can corrupt, as successful Wall Street hedge fund manager Guy Spear found out to his cost. To succeed in the competitive world of finance, he set out on a quest to better himself.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries, and feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.